Hello everyone. Today we will look at the topic of reinsurance commission. So who is paying commission to who? So we have discussed earlier that commission is paid by the reinsurance company to the insurer for some reasons. Okay, why reinsurance commission is paid by the reinsurer? First is to pay back the insurance company acquisition costs that they have incurred. And acquisition costs can be many examples, such as fees incurred to pay to the agent or broker, advertising costs, and so on. Also, cost incurred, management expenses is a cost incurred by the insurer to manage the session or to manage the treaty. And also, commission is paid to the insurer to share part of the profit made by reinsurer. So at the end of the financial year, reinsurer is either making a profit or making a loss. So there will be a calculation to decide whether they're going to be profit or loss at the end of the financial year. Commission is paid if reinsurer is allowed or is entitled to receive percentage share of full gross premium without deduction of acquisition and management expenses. So what does that mean? Let's say we have an example of two situations here. The first is net premium basis, and the second situation is gross premium basis. Okay, under net premium basis, for example, we have one risk with an original gross premium of 150,000, and the insurer incurred a cost of 2,300 to incur that risk. When they acquire the risk, insurer will have to pay 2,300, such as advertising costs. And as a result of that, the net premium is 147,700, which is OGP minus acquisition cost. So for net premium basis, let's say how much premium is ceded to the reinsurer. For example, reinsurer is entitled to get 65%, meaning that 65% of the net premium. So they're going to be 96,005 ringgit of premium ceded to the reinsurer. So in this situation, in this case, net premium basis, there going to be no commission paid to the insurer because the insurer has already deducted the original gross premium with the acquisition cost. So why should the reinsurer reimburse back this cost when they already have deducted this cost to get the net premium? And reinsurer is getting their share of premium ceded by looking at the net premium. So there's going to be no commission paid in this case. The second situation, gross premium basis. For example, the same risk with an original gross premium of 150,000 and the commission rate or the flat rate has been fixed at 25%. Percentage ceded to reinsurer, let's say 65%. That's going to be 65% of this OGP is 97,500. So in this situation, commission is paid because there is no deduction of acquisition cost from the acquisition. Sorry, there is no deduction of acquisition cost from the OGP. So let's say commission rate is 25%. So 25% of this amount is paid to the insurer as a commission. I hope you are clear with that. Normally, no commission is allowed if proportional treaty are on a net premium basis. So as I explained earlier, there going to be no commission paid by the reinsurer to the insurer if the treaty is arranged based on net premium basis. Talking about commission, there are three types or three schemes of reinsurance commission that you have to know. The first one is called flat rate commission. The second one is called sliding scale, and the third one is called profit commission. So what is flat rate commission? The name flat rate means the commission rate will not change. The rate will stay. The rate is consistent. The rate will not change whether there is a loss or whether there is a profit made by the reinsurer. Irrespective of profit or loss made by the reinsurer, they're going to be commission paid by the insurer. So this is payable by reinsurer to pay back the insurer acquisition costs and their management expenses. Flat rate commission apply only to proportional treaty. I hope you can recall back that under proportional treaty, they are sharing the original risk. So that's the reason why there is commission paid by the reinsurer to the insurer, because they are sharing the risk, the original risk. Instead, other than claims and loss, under proportional treaty, there are three items that are being shared, if you can recall back: original risk, original premium, and claims. Okay, how much is the rate applied? Commission rate will be different between countries, and this rate can be between 25% to 40%, and it is based on original gross premium. Commission rate will normally determine the based on the acquisition and management cost and profit earned by reinsurer. But there is a problem here. If high flat rate, they're going to be a bit of problem in the future, because high flat rate separate the interest of the parties. In this case, the cedent might have an intention, or the insurer might have the intention just to gain high commission without maintaining their standard of underwriting. So this might result underwriting loss to the reinsurer, because in this situation, insurer is looking for profit because they just want to cede the risk for reason of getting profit, because they know that every time they cede a risk, they're going to get a high commission rate. So that in this situation, it's going to be a bit of problem to the insurer, to the reinsurer, because the reinsurer knows that they are getting some of the bad risk, because the insurer doesn't care. As long as they get high rate commission, they will just cede any risk without giving attention to their underwriting standard. Okay, anyhow, flat rate commission. So let's look at the example. Flat rate commission, let's say for average risk ceded, reinsurer will pay 25%. So let's say we have three risks here: risk 1, risk 2, risk 3, with different amount of premium ceded. So for each of the risk ceded, insurer is getting a commission of this amount. Let's say for risk 1, with a premium ceded of 150,000, reinsurer is paying 37,500 to the insurer, and the rate is consistent, or it is fixed, even though each risk has different amount of premium ceded. Okay, let's go back to the PowerPoint. Sliding scale commission. Okay, the second scheme of commission is called sliding scale. Why it is called sliding scale? Because there is a scale used. Sliding scale commission depend very much on the loss ratio of the treaty. So the formula of loss ratio, if you are aware or you can recall, loss ratio is incurred claims or incurred losses divided by premium earned times 100%. So you get the loss ratio. So in this type of commission scheme, the lower the loss ratio, meaning that the higher the profit commission rate. So in other words, the rate of commission paid by the reinsurer to the insurer is inversely proportional to loss ratio. Meaning that if the loss ratio is low, the profit commission rate is high. If the loss ratio is high, that will result in a low profit commission rate. That's why it is called inversely proportional. So the commission payable is based on the agreed upon the commission scale and loss ratio ranges of the previous year. So there is a scale and loss ratio ranges used. Let's see if I have example for that. Okay, here. Let's say this is the scale used for loss ratio. So we have, if the loss ratio is less than 55%, the commission rate will be 40% maximum. So this is maximum. So let's see the lowest ratio here. If the loss ratio is very bad, let's say over 64% of the treaty year, they calculate the loss ratio is more than 64%. That will result in a very, very low commission rate of 27.5%. So look, the lower the loss ratio, the higher gonna be the commission rate. The higher the loss ratio, the lower gonna be the commission rate. Whatever it is, even though the loss ratio is 100%, which is impossible, that will also result in a commission rate of 25.5%, because this is minimum and this is maximum. So either they're going to be huge loss ratio or low loss ratio. Insurer is guaranteed or is promised to get some rate of commission paid by the reinsurer. Okay, I hope you are clear with that. So we move to the third one. Okay, this is called profit commission. Okay, the name profit suggests that reinsurer must make profit. From the profit and loss account of the reinsurer, they will calculate whether they're going to be profit or loss. If there is profit, they're going to be commission paid to the insurer. If there is a loss, there's going to be no commission paid to the insurer. So that's why it is called extra commission. So this extra commission is paid to the insurer over and above the flat rate. Okay, flat rate is guaranteed. No matter whether there is loss or profit, insurer is getting commission for each of risk ceded. But profit commission is extra commission. It is conditional upon the profit and loss result of the reinsurer. So profit commission is paid at the end of each treaty year and based on the net profit made by the reinsurer. So profit will be calculated based on agreed formula. So there's going to be a formula used, and this formula depends on the accounting system or the treaty system used. Remember, there are three types of treaty: underwriting year basis, accounting year basis, and occurrence basis. These three bases will determine the formula used. So profit commission paid is based on an agreed rate multiplied by the net profit made by the reinsurer, normally between 10 to 20%. The rate going to be between 10 to 20%. It can be 12%, it can be 15%, it can be 70%, it can be 80%, and so on. As I mentioned earlier, if there is a loss, there going to be no profit commission paid at all. So calculation of profit and loss account will be different depending on the type of treaty used. So if it is accounting year basis, the calculation of profit and loss will be different with occurrence year basis and underwriting year basis. Okay, thank you very much.